The markets just did something insane. The US government shut down, job losses piled up, and somehow, stocks soared. How does that even make sense? This week revealed one of the strangest forces driving global markets right now. The bad news is good news paradox. Weak economic data, traders cheer, job losses, stocks rise, because in today's market, pain means rate cuts, and rate cuts mean profits. In this breakdown, we'll show you why this upside-down rally happened, how it spread across continents, and the 5 critical risks that could flip this optimism overnight. So if you want to actually understand what moves the markets, not just follow the headlines, like, share, and subscribe, and watch the full video until the end. Because what's coming next could change everything.
Okay, so this week, the market did something that, on the surface, makes absolutely no sense. We got hit with a government shutdown and some pretty terrible job numbers, but somehow, stocks just soared. In this explainer, we're going to unpack exactly what is going on. Right? It feels completely backwards, doesn't it? I mean, how on earth can all this genuinely bad news lead to a sea of green across all the trading screens? Well, the answer reveals this really strange but incredibly powerful force that's at work in the market today. And here it is. It's a phenomenon investors call bad news is good news. And the logic, well, it's actually pretty simple. When the economic data starts to look really bad, the market starts betting that the Federal Reserve will have no choice but to step in and cut interest rates to juice the economy. And just the hope of that cheaper money is more than enough to send stocks flying higher. To see this in action, we really don't have to look any further than what happened in the United States this past week. It was like the perfect case study of this whole paradox playing out in real time. And wow, the market's reaction was immediate and it was strong. As you can see, the S&P 500 climbed over 1%, the Nasdaq was up even more. Now, these would be solid gains in any normal week, but they are absolutely extraordinary given the backdrop of all those negative headlines. So, let's set the stage. This was the first piece of bad news. A government shutdown kicked in, and just like that, 750,000 federal employees were out of work. And here's the kicker. This also meant a data blackout. The very government agencies that tell us how the economy is doing, they just went dark. But we did get one crucial piece of data before everything went offline, and honestly, it was a shocker. The ADP report on private sector jobs was supposed to show a gain of 51,000 jobs. Instead, it showed a loss of 32,000. This was the cold, hard evidence investors needed to see that, yep, the economy was slowing down. And boom, this is the paradox in action. The market looked at that awful jobs number and didn't see weakness. It saw a bright, flashing neon sign telling the Fed to act. The odds of an interest rate cut just shot through the roof because, lower borrowing costs make it so much easier for companies, especially those big tech companies, to grow. But hold on. The market's reaction wasn't just about hoping for the Fed to save the day. All of that underlying uncertainty also kicked off a classic flight to safety, where investors just scramble for assets that are known to hold their value when things get turbulent. And when you look at how different assets performed, you see some really wild splits. Just take oil, for instance. Crude prices plunged 7%. Now that is a huge drop, and it signals that traders are bracing for lower economic demand all around the world. And to add fuel to the fire, OPEC Plus announced plans to actually increase supply, which just pushed prices down even further. Now, on the complete flip side, look at gold. The ultimate safe haven asset surged over 3% to a brand new record high. It's simple. When investors get nervous, they buy gold. This plunge in oil at the exact same time as a surge in gold, that's a textbook signal of major economic anxiety. And this whole thing wasn't just a U.S. story. Oh no, the optimism, or maybe we should call it the hope for stimulus, spilled over and had a massive impact on markets all around the world, starting right in Europe. Believe it or not, European markets actually had an even better week, hitting new all-time highs. But what's so important to understand here is that this rally had nothing to do with Europe's own economy. It was all driven by the hope that U.S. rate cuts would unleash this massive wave of cheap money that would just spill over and boost assets everywhere. Because, when you actually look at Europe's own economic report card, the picture is, well, it's pretty mixed. Headline inflation actually ticked up, unemployment also edged a little bit higher, and consumer confidence is still way down in the dumps, even with a tiny improvement. This is not exactly the kind of foundation you build a record-breaking rally on. And this quote from ECB President Christine Lagarde really tells you everything you need to know. Despite that little uptick in inflation, the European Central Bank is basically signaling, hey, we're in no hurry to raise interest rates. She says the risks are contained, which just gives the market even more confidence that, yeah, the easy money policy is going to stick around. So while Europe was happily riding that American wave, the story over in Asia was much, much more complicated. The major economies there are facing their own unique set of challenges, and they are definitely not following the same script. You can really boil it down to two completely different narratives playing out at the same time. You've got Japan, where the central bank is actually getting ready to raise interest rates and tighten things up. And then you've got China, where the economy is still just searching for any kind of spark to reignite its growth. So in Japan, we're seeing the literal opposite of what's happening in the West. The Bank of Japan's governor has made it crystal clear that rate hikes are on the way. The bond market is already reacting, with the 10-year yield rising, and the yen has been getting stronger. This is a country that's finally moving back toward normal. And then there's China, whose economy is really struggling to find any momentum. The latest data shows manufacturing is still shrinking, and the super important services sector is just stagnant, flat. This weakness in the world's second biggest economy is a huge drag, and all eyes are on the Golden Week holiday, hoping for some sign of life from the Chinese consumer. Okay, so the market had a fantastic week, running purely on the hope of more stimulus. But, and this is a big but, this entire rally is built on a pretty fragile foundation. So let's look at 5 key risks that could very quickly flip the script and spoil this whole party in the week ahead. First up, the Fed. With that data blackout, any surprisingly tough talk from them could cause some serious market whiplash. Second, keep an eye on energy prices. If oil keeps falling, that could signal a much deeper economic slowdown than anyone expects. Third, any more weak data out of Europe could kill their rally dead in its tracks. Fourth, China. If that Golden Week spending is a dud, it'll confirm everyone's worst fears about their consumer. And finally, Japan. If their bond yield spiked too quickly, it makes borrowing more expensive not just for them, but for the entire world. So here's the bottom line, the crucial point in all of this. The entire bad news is good news rally is a bet. It's built on hope for future action from the Fed. But the actual data we're seeing, from job losses here in the US to manufacturing weakness in China, it all suggests the underlying economic reality is genuinely fragile. There is a huge disconnect right now between market optimism and the economic fundamentals. And that leaves us with this one big final question. We've seen exactly how bad news can get twisted into good news. But in a market that has become this addicted to the idea of stimulus, has our entire definition of risk just been completely warped? It really makes you wonder, is there any news out there that could actually break the spell? Something to think about. Thanks for tuning in.
If you found this breakdown useful, hit like and share it. It helps more people discover MacroNav. And if you want more clear, no-nonsense explainers on global macro and finance, make sure you're subscribed. Stay ahead, stay informed.